You think trading started on Wall Street? Men in suits screaming on a floor, phones to both ears, numbers flashing red and green. It didn't. Trading is older than money, older than writing, older than cities. The first trade happened before anyone could record that it had happened at all, and we can prove it. Long before farming, humans were already moving goods across enormous distances. Archaeologists keep finding the same thing. Obsidian, the black volcanic glass prized for sharp blades, sitting in ancient settlements hundreds of miles from the only volcanoes that could have produced it. Seashells turn up deep inland, nowhere near a coast. These objects did not walk. They were carried, passed from hand to hand, group to group, across distances no single person ever traveled. That is the first trade. Not a market, not a price, just one human handing another something they couldn't get themselves and getting something back. And here is what mattered. The moment two strangers could trade, they had a reason not to fight, and they no longer had to be the same. A toolmaker could eat by making tools. A fisherman could carry blades without ever touching stone. Trade didn't just move objects, it let strangers depend on one another. That single idea quietly built everything that came after. As villages grew into kingdoms, trade stopped being local. It stretched into long-distance routes, and whoever controlled the route controlled the wealth. The Phoenicians are a clear example. They didn't dominate the Mediterranean with armies. They did it with ships, trading purple dye, glass, cedar, and metal from one port to the next. And as they traded, they carried something more powerful than any cargo: their alphabet, a simple writing system that spread along their trade lines and became the ancestor of the letters most of the world still uses today. Then came the routes that defined an age. The Silk Road was never a single road, it was a web of overland and sea paths linking China to the Mediterranean. Silk and other goods moved west, silver and gold moved east, and almost no one traveled the whole distance. A bolt of silk could change hands many times, each merchant taking a cut before it ever reached a buyer at the far end. Riding those same routes came spices: pepper, cinnamon, cloves, nutmeg. In Europe, they were worth fortunes, partly because they came from places Europeans could not reach and, for a long time, could not even locate. The traders in the middle had every reason to keep the sources vague. As long as the origin stayed a mystery, the markup stayed enormous. That secrecy is a large part of why Europe eventually went looking for direct routes by sea, sending explorers around Africa and across the Atlantic. A great deal of the age of exploration was, at bottom, an attempt to cut out the middleman. For thousands of years, trading meant goods moving between people. Then the Dutch did something genuinely new. They started trading the company itself. In 1602, the Dutch East India Company faced voyages so expensive and so risky that no single person could fund one. So it split ownership into pieces, shares, and sold them to the public. Buy a share and you owned a sliver of every voyage and every profit. And if you wanted your money back before the ships returned, you could sell that share to someone else. To make that possible, Amsterdam developed a market where these shares were bought and sold continuously. It is widely regarded as the birth of the modern stock exchange. For the first time, the thing being traded was not a physical good at all. It was ownership. It was a claim on profits that did not yet exist. That was the crack that would shape the next 400 years. Because a share has no fixed value. It is worth only what the next person will pay for it. And the moment people began trading expectations instead of objects, prices could be driven by belief alone. The clearest early case was a flower. In the Dutch Republic of the 1630s, rare tulip bulbs, especially ones with striking streaked petals, became luxury status symbols. Prices climbed, and traders began buying bulbs not to plant them, but to resell them at a profit, often trading paper contracts for bulbs still in the ground. At the peak in early 1637, the rarest bulbs reportedly fetched extraordinary sums. Then, almost overnight, buyers simply stopped showing up and prices for those rare bulbs collapsed. It is often called the first well-documented speculative bubble. It's worth being honest, though. Later historians have shown the popular image of a nation financially ruined is exaggerated. The lasting economic damage was limited, and the legend grew taller in the retelling. But the core mechanism was real, and it would return again and again. A real thing, lifted by speculation, bought mostly to be resold until the last buyer finds no one behind them. Within a century, whole nations made that same bet. In France around 1719 and 1720, a financier named John Law built a company around the supposed riches of French territory along the Mississippi. Shares soared, and the boom helped popularize a brand new word for the fortunes it created: millionaire. Across the channel at almost the same time, Britain's South Sea Company promised vast profits from trade that never truly materialized, and its shares rocketed and then crashed in 1720. Even Isaac Newton, one of the greatest minds who ever lived, is recorded as having lost a large sum in the South Sea collapse. The lesson that empires kept failing to absorb is simple. Raw intelligence does not protect you because the crowd has its own momentum, and the most dangerous moment is usually when everyone agrees that nothing can go wrong. After that, trading found a physical home: the floor. In New York in 1792, a group of brokers signed an agreement to trade with one another on Wall Street, a street that took its name from a defensive wall built by the early Dutch settlers. That agreement grew into the New York Stock Exchange. Then, in 1867, a machine changed the tempo of everything: the stock ticker. For the first time, prices could travel by telegraph and print onto a ribbon of paper far from the exchange itself within minutes. A trade in New York was no longer only a New York event, and the floor became a spectacle. Hundreds of traders packed together, shouting and signaling by hand because no voice could carry over the roar. Open outcry. Out of pure human noise, somehow, a price. The bigger the market grew, the harder it could fall. In 1929, after years in which ordinary people had bought stocks heavily with borrowed money, the market broke. Over the course of late October, prices crashed so fast that the ticker fell hours behind, unable to keep up. Enormous sums vanished, and the crash helped tip the world into the Great Depression. We told ourselves we had learned, and we built rules and regulators. Then came Black Monday, October 19, 1987, when the market fell more than 20% in a single day, the worst one-day drop in its history. And this time there was a new factor. Automated trading programs set to sell as prices fell, sold all at once, each wave triggering the next. In a cascade no single human had ordered and no single human could halt. The machines were already in the room. Then quietly, the shouting stopped. Through the 1990s and 2000s, trading moved off the floor and into the wire. Electronic systems could match a buyer and a seller in a fraction of a second, and the great trading floors emptied out. The roar that had defined finance for over a century faded into the hum of servers in plain buildings. Once trading became code, a new kind of trader appeared, one that never sleeps and never feels fear or greed. This is high-frequency trading, where firms compete not in dollars, but in millionths of a second. They have paid to lay fiber optic cables in the straightest possible lines between major exchanges and to place their servers physically closer to the exchange's computers, all to shave microscopic slivers of time off how fast they can react. At those speeds, a trade is finished before any human could even perceive it beginning. The market stopped being a place. It became a contest between machines, fought in stretches of time too small for a human mind to enter. For a while, it looked as if trading belonged only to the machines and the giants. Then the phone in your pocket changed the board again. Apps made trading nearly free and almost instant. No broker visit, no fee, just a thumb. And in early 2021, the crowd discovered its own strange power. Coordinating online, large numbers of small traders piled into a struggling video game retailer that big funds had bet heavily against. The price exploded upward, and some of those funds lost billions on their bets. For a moment, it looked like the smallest traders had beaten the largest. The reality was messier, and plenty of ordinary buyers lost money too when the price later fell. But strip away the details, and it was the oldest pattern wearing new clothes. A thing bought mostly to be resold, lifted by belief until the momentum reversed. And then one more wall came down. Cryptocurrency markets do not close. There is no opening bell and no closing bell, no floor, no single headquarters, no country. They trade every second of every day all over the world at once, governed by code rather than any government. For the first time, the market never stops, and the booms and crashes that once unfolded over years can now play out in hours, the same old cycle replaying on fast forward across screens everywhere. But that is not where this ends. Because the trader is changing one final time, the fastest and most sophisticated participants are increasingly not people at all, but algorithms and more learning systems that decide for themselves what to buy and sell, trained on more data than any human could read in many lifetimes. We are building markets that move too fast for us to watch, traded by systems that are not us, making choices we cannot follow in real time. Trading began as the most human thing imaginable. Two strangers choosing exchange over violence, dependence over isolation. The obsidian moved at the speed of a walking person. The trade now moves at the speed of light, decided by machines, in markets that never sleep. And the human hands are quietly leaving the room. For all of history, the question behind every trade was simple. What is it worth to you? That question is now changing into something stranger, because soon you may not be the one answering it. So as the last human hands leave the trade, ask yourself the only question that has ever really mattered. When the machines are doing the buying and the selling, who is the trade actually for? And will it still be you?